Now we will discuss about multi-period case. In the previous discussion we have seen for single period, 1 year, single present value, single future value and a rate of interest. We calculated and we saw the net present value. If positive, we accept or reject. Now this section we will discuss about multi-period case. General formula for future value of an investment over many periods can be written as same. You see, there you have seen future value is equal to present value multiplied by 1 plus r. Now, if it is multi-period, we will give the power of the multi-period like this. We have seen future value is equal to present value multiplied by 1 plus r. To the power t we have not written. Why? Because it was 1 period, 1 year. If it is multi-period, 2 year, 3 year, 5 year, then simply 1 plus r to the power t. So future value is equal to present value multiplied by 1 plus r to the power t, where PV is the present value, r is the rate of interest, t is the number of period. Let us take an example. Suppose a stock currently pays a dividend of $1.10, which is expected to grow at 40% per year for next 5 years. What will be the, if you hold the stock till 5 years, what will be the dividend in the 5 years? Future value is equal to present value 1 plus r to the power t. Currently it pays how much? $1.10. That is the present value multiplied by the growth expected is 40%. So 1.4 to the power 5 year. We want to know what will be the dividend in the 5th year. So present value multiplied by 1 plus r to the power t is equal to future value. Hope it is clear. If you hold the stock till 5 year, the dividend of the 5th year the company will offer you is $5.92. Notice that the dividend in year 5 is 5.92. It's considerably higher than the sum of the original dividend plus 5 increase of 40% on the original $1.10. Isn't it, students? You see, original payment is $1.10. Now the dividend paid. 40% of 1.10, if simply 1.10 multiplied by 40% for 5 years if you do, that will be lesser than 5.92. Why like that? Because 5.92 is greater than 1.10, that is the payment made now, plus 5 multiplied by 1.10 to the power 40%. You see, 1.10 is the current payment. 40% of that will be 1.10 multiplied by 0.4. If that is yearly once, then 5 year is equal to 5 multiplied by 1.10 to the power 1.10 multiplied by 40% is equal to 3.30. But the dividend in the 5th year will be 5.92. How it is possible? You understand? The dividend paid now is 1.10. Yearly growth expected is 40%. 40% of 1.10, you are holding for 5 years multiplied by 5 plus the original dividend now is equal to 3.30. But as per the future value function, we have seen the dividend in the 5th year will be 5.92, which is much higher than 3.30. Why like that? This above 3.30 is simple interest. Why? 1.10 multiplied by 40% is the yearly growth, simple interest multiplied by 5 plus the original amount principal value will be 3.3. But we are not doing simple interest. Interest is compounded here. How? Let us see this. 1.10 right now. Alright? Next year dividend will be 1.10 multiplied by single period. Remember the single period future value. So 1.10 now. After 1 year at 40%, future value will be 1.10 multiplied by 1.40 is equal to 1.54. Now, dividend in second year will not be this. Dividend in second year will be 1.54 multiplied by 1.40 is equal to 2.16. Dividend in the third year will be 2.16 multiplied by 1.40 or 1.10 multiplied by 1.40 to the power 3. In the fourth year it will be 3.02 multiplied by 1.40 or 1.10 multiplied by 1.4 to the power 4. And in the fifth year, dividend will be 4.23 multiplied by 1.40. Previous year's present value multiplied by 1 plus r. Or original present value multiplied by 1 plus r to the power 5, which is equal to 5.92. Understand? Clear? So this is the way we get the compounding impact. How much would an investor have to set aside today in order to have 20,000 5 years from now if the current rate is 15%? Do your calculation please. So how much someone has to keep money, or how much an investor has to keep money right now to have 20,000 after 5 years if the rate of interest is 15%. Very simple. Future value after 5 years means future value. Future value is given 20,000. Rate of return or rate of interest is given 15%. We need the present value. Present value is equal to future value divided by 1 plus r to the power t. So 20,000 divided by 1.15 to the power 5. Okay, 20,000 divided by 1.15 to the power 5. Future value divided by 1 plus r to the power t will be the present value. Alright, clear? If we deposit 5,000 today in an account paying 10%, how long does it take to grow to 10,000? So, here we are trying to calculate the number of period. Why? Present value given 5,000. Future value given 10,000. Rate of interest given 10%. So, future value is equal to present value multiplied by 1 plus r to the power t. 10,000 is equal to 5,000 multiplied by 1.10 to the power t. Let us calculate the t. 1.10 is to the power t is equal to 10,000 divided by 5,000 is equal to 2. Now let us do logarithm both side. So t logarithm 1.10 is equal to logarithm 2, or t is equal to ln 2 divided by ln 1.10 is equal to 7.27 years. Alright. Now what rate is enough for you? Assume the total cost of college education will be 50,000 when your child enters college in 12 years. So he is a small child now. After 12 years he will go for the college education. That time it will be 50,000 cost. Kindly note it down. 50,000 will be the college education after 12 years. You have 5,000 to invest today. What rate of interest must you earn on your investment to cover the cost of your child's education? You see, in the previous one, we calculated the number of period, how many years it will take to make your 5,000 to become 10,000 at 10%. It will take 7.27 years. Here we calculated the n or number of periods. Here we want to calculate the rate of return. Why? Present value there 5,000, future value there 50,000, number of years there 12. But what is missing? R. You can calculate the rate. At what rate your 5,000 will become 50,000 after 12 years? Very simple, same formula. Future value is equal to present value multiplied by 1 plus R to the power t. Then 1 plus R to the power t is equal to 1 plus R to the power 12 is equal to 50,000 divided by 5,000 is equal to 10. 1 plus R will be equal to 10 to the power 1 by 12. Or R is equal to 10 to the power 1 by 2 minus 1 is equal to 21.15%. You have to find an investment which will give you around 21.15% so that your 5,000 will become 50,000 after 12 years. Alright, clear? Interesting? Of course, all these things we will see in the spreadsheet. Already I have given the spreadsheet in your folder. The spreadsheet you open so that next discussion will be how to calculate all these present value, future value, rate of return, time period, everything we can calculate through the spreadsheet. So about 21.15% is the required return to make 5,000 today, to make 50,000 after 12 years. So calculator keys, if you use a Texas Instrument BA2 plus, then FV stands for future value, PV stands for present value, IY stands for interest rate, PY must be 1 for IY. How you do it? Do you have anyone who wants to do the calculator function? Do you have calculator, anyone? Okay, so if you open your BA2 plus, there is a key called second button. Click the second, then click on the IY. Then it will show you PY is equal to 1. If it is not showing 1, make it 1. PY, for example, showing 2, then make it 1, enter. Then it will be PY is equal to 1. Then the other calculation the calculator can do for you. Interest is entered as a percentage, not as a decimal. If it is 10%, enter as 10, not 0.1. N is the number of periods. Remember to clear the time value table. Time value table is the third row of the calculator, where it is 5 buttons are there. In the third row, you will have 5 buttons: N, IY, PV, PMT, FV. These are the 5 keys available in the third row. This is known as time value table. This time value table always should be clear before doing a new exercise. How it can be done? Always second key and clear TVM key, that is FV key. So second clear TVM will clear everything, previous entries will be cleared by the calculator, then the fresh entry can be done. Other calculators are similar in format. Consider an investment that pays 200 1 year from now, with cash flows increasing by 200 per year through year 4. If the interest rate is 12%, what is the present value of this stream of cash flows? If the issuer offers this investment for 1500, should you purchase it? Very simple. 200 1 year from now. A company is offering you, you give 1500 now, and the company will give you 200 after 1 year, 400 second year, 600 third year, 800 fourth year. Should you accept this offer if the rate of interest is 12%? Very simple. 200 after 1 year, what is the present value today? At 12%, 178.57. 400 after 2 years, what is the present value today? 318.88 at 12%. 400 divided by 1.12 to the power 3 will to the power 2 will be the value, because 12% is the interest rate. So 400 divided by 1.12 to the power 3 is 318.88. 600 after 3 years. What is the present value today? 600 divided by 1.12 to the power 3, 427.07. 800 after 4 years. What is the present value today? 800 divided by 1.12 to the power 4, 1432.93. But this is manual calculation is tedious, and do not purchase this investment. Why? Your company is asking for 1500, whereas the present value is 1432. The money which he is giving you, 200 after 1 year, 400 after 2 year, 600 after 3 year, 800 after 4 year, that present value is 1432. He is claiming 1500, so it's not a profitable one. Do not purchase. So first set your calculator to one payment per year. How you do it? There is a cash flow function in the calculator. In the second row, first and second column. What you will do? Cash flow, second, clear. Then it will come CFO 0 is equal to 0. Down arrow, it is asking CF1, enter 200. Then don't forget to enter key. Next, again down arrow, FO1 is equal to 1. Enter. CO2. CO2 is 400. Enter. Down arrow. FO1, FO2 is equal to 1. Again down arrow. CO3. CO3 is 600. Enter. Again down arrow. FO3 is equal to 1. Again down arrow. CO4. CO4 is 800. Enter. Again down arrow. FO4 is equal to 1. Now, what we will do? We will click on NPV. It is asking you I. I is always the rate of return. I is 12% here. Enter 12. Enter. Then down arrow, it is asking NPV. Click on CPT. CPT is compute. It will give you 1432.93. 1432.93. So this is the way we do it from financial calculator, but this one will be more easier when we do in the Excel spreadsheet, and that will be what you need to do. Of course, financial calculator is also making easier the life. Doing from manually is much tedious than doing through a financial calculator, but through Excel spreadsheet it is further easier. I will explain you how. Now compounding periods, before taking the compounding periods, let me stop the recording here.